Welcome to the Property and Coffee Podcast. I'm your host, Matt Atkinson.
I'm Matt Skehan.
We'll be fueling your financial future, one coffee and property insights at a time.
Helping you navigate the property market like a pro.
Hello, and what a pleasure it is to have your company today on the Property and Coffee Podcast, where we are going to be fueling your financial future, one coffee and property insights at a time. Joined by my co-host, Matt Skehan, and I'm Matt Atkinson. So today, we're going to be chatting with the gentleman on my left, Kartik Lakhani. He is a director at Lakhani Co, an accounting advisory firm. We're going to be breaking down some of the recent, as you would have seen across the news, the proposed changes that have come up as part of the budget speech that's been handed down, and just understand a bit more around what those mean. And also what that means and what we can do to understand those and potentially make sure that we take advantage of what the proposed changes are. It is also important to note, although we typically speak around bricks and mortar, around a way of building your wealth, it is, that can also be heavily impacted by the federal regulatory landscape. Couple of themes that we're going to be touching on. The first is just around the process around the federal budget and what that timeline looks like and how it comes from a proposed budget actually into law. Unpacking a bit of the negative gearing and capital gains reforms. Just some strategies, a few things that were highlighted in the budget, looking at individuals, companies, and trusts. And then just a few things to wrap up and understand, what people can take away that they might be able to use to their advantage as they look forward to the future. Maddie, I'll let you kick it off.
Cool, got the hard one up first, mate. So, favourite coffee and where's your go-to cafe, mate? So for your favourite brew.
I do like a black coffee. I used to enjoy a latte once upon a time, but as I get older, I'm finding milk doesn't necessarily agree with me as much, or rather, milk is a bad choice.
And you get more bitter.
No, there's that as well. Now there's a little cafe out in Ringwood called Little Buddy Cafe, so I do enjoy their beans, enjoy their coffee. Yeah, so it's good. Need one in the morning, maybe two in the morning to get going, but yeah, it's good.
Fantastic.
Let's get straight into it. We want to get into the federal budget, the process and the timeline. Let's just talk through budgets come through, mixed reaction, I think it's probably fair to say, across the board. And
tattle.
That's it. And, you don't want people to panic. I think everyone's trying to understand what it means. Where we want to start is just understand what actually happens next. So the budget's been handed down. There's obviously, like any budget, there's a range of different changes or items that have been proposed. What's the next step for that to officially sort of be passed by the government?
So they had the budget announcement, obviously, and then they released the budget papers, which contained a lot of the detail, the thought process, the logic behind those announcements. And then they basically go away, they draft the legislation, with the idea being that legislation then goes through Parliament. It basically gets debated and assuming that it passes both houses of Parliament, you'll then get royal assent and in effect it'll then become law. So that at a higher level is the process. I think at the moment, particularly for the CGT and negative gearing changes, I know that those are already in the House of Representatives. I think the indications are that it is going to pass, or has passed, or will pass. And I think then it'll go into the Senate. So I think that's where we're at the moment. The important thing to note is there are some of the measures that don't actually require legislation and law, but the main ones that I suppose you and probably your audience are interested in will require legislation and do need to receive royal assent before they become legislation.
Cool. So Kartik, the Senate balance, we often hear about the House of Representatives and the Senate locked in debate over appropriation bills. What happens if the government can't get support from the minor parties or the opposition on board in the Senate? Can these be blocked, these changes, or altered?
Yeah, so budget measures can definitely fail, such as when the government of the day can't get sufficient support. And look, they can be blocked or they can be sort of drastically altered. I mean, and it has happened a few times in recent history. So proposed GP co-payments, I think the Rudd government had the resource super profits tax. Turnbull Morrison had much heavier company tax cuts, particularly for large companies that didn't sort of go through. So it can happen. I think, however, I mean, I'm not a political analyst, but based on everything I've read and heard so far, it seems likely that they will go through as they're sort of currently drafted. At least I think the negative gearing and the capital gains tax changes. Apparently Labor has a political capital and is likely to get the support from those minor parties. So everything I've read sort of suggests that it will happen. And it's, you can probably start planning around the implementation of those particular laws. I think the trust specific laws, I think there might still be some changes in relation to those, but watch the space, I guess.
Interesting time in that space. Let's maybe just touch on one of those last points. So the proposed changes to the negative gearing and CGT slated for 1 July 27. Why is there a lag, or if you want to call it a long lag, between the announcements and the actual start dates?
Yeah. I mean, I think generally when you have something this big going through, typically they will allow some time to sort of, that transition to occur. If you imagine that budget night, whatever it was, 12 May or whatever it was, they came on and said, hey, these changes apply from tomorrow, everyone would be on a panic. So I think it is the right way to go about making these sorts of changes, to give taxpayers and the public at large time to adjust and normalize behaviors or plan accordingly. Not to sit there and say we necessarily have to like the changes, but that is probably the reason why that sort of lag, if you like, is there.
Very kind of them.
Indeed.
And the last one on this theme there, Kartik, so the advice dilemma. So from an accountant's perspective, like how do you advise clients when a major tax policy has been announced and introduced as a bill but hasn't officially passed Parliament yet? Is there any... is it safe to make investment decisions based on the proposed budget? I think you've touched on that a little bit already, but you've probably had a few calls recently.
Yeah, it's a tough one. I remember, I think I got a call literally as the budget was being announced. One of our closer clients called me immediately and saying, Kartik, can you explain? I said, look, give me 6 to 12 hours and I'll come back to you with a more sort of reasoned answer. But look, we are having some very tough conversations with clients at the moment, with key issues really around structuring, particularly given that these proposed changes, will impact things like trusts. And also, it might impact in terms of what type of assets to acquire, right? When you talk about new bills, existing bills, gearing, positively geared, negatively geared, et cetera. So really sort of having those conversations, at least from a tax perspective, definitely we're sort of having a lot of those conversations. I think for us, though, the big thing is when you talk about wealth accumulation, which is a space that you guys really play in when you talk about sort of how to acquire and build wealth over a long period of time. The name of the game is wealth accumulation. The idea is to try and build wealth. So the fundamentals of that process still haven't changed. You're still looking at buying good quality assets to hold over long periods of time, to have that capital appreciation and build your wealth around that. So, I think conversations we're having with clients is really, you still need to focus on that aspect of wealth accumulation. So to sit there and say it's not safe to make investment decisions, no, I think it's definitely safe to make those decisions. In fact, I'd argue to some extent, if we're talking property as an example, some locations have become a real buyer's market, right? Because we do a bit of work in that property space as well. There are some absolute gems out there that we've seen for purchase. So I would definitely be still looking at investing. But yeah, I think you need to probably still just consider the tax implications of the particular type of asset you're buying and sort of how that needs to be structured. But yeah, to sit there and say that, is it safe to invest? And I think there is a lot of fear out in the marketplace at the moment. I'm sure you guys are seeing that as well. For me, I sort of a bit more contrarian. I like to think that there is opportunities there based on that. And there are a lot of good buying opportunities, I think. So yeah, definitely safe to make those decisions, but yes, you need to be careful with how you structure, and you need to have those conversations with your accountant. If your accountant hasn't really earned his fee so far, now's a good time for him to do so and sort of get some advice around how to go forward with that.
Sure. Wise words, mate. So moving on to the next theme, so unpacking the negative gearing and the CGT reform. So the quarantine cash flow, can you break that negative gearing changes? So assuming they're all passed, if someone buys an established property today, they can no longer offset rental losses against their salary, so their losses are quarantined. Can you explain what that means in plain English, and how it alters a investor's sort of annual cash flow?
I'll do my best to try and switch off my accounting brain and get into the technical aspects of it. But in a nutshell, under the current rules, if you have negative gearing, that is, you have losses on your rental property, and you have other income like your salary and wages, you can offset the two. So if you've got 10K of negative gearing and 100K of income, your taxable income will come down to 90K. So you can offset the two. Good tax benefit. Helps a lot for property investors in the initial years where the holding costs tend to be quite high. So highly beneficial, obviously, from that perspective. Under the new rules, what they're basically saying is that those rental property losses, if they're there, cannot be offset against your current other taxable income, so your salary, your wages predominantly. So it just means that they're set aside to be used against future rental income or future capital gains on that rental property. Now, I think there's still a little bit of confusion as to what specifically is defined as other income. Does it include interest, dividends, trust distributions, things like this? But I mean, if we just assume at the time being that they're talking specifically about rental properties in that regard, it'll be offset against future rental income, profits, if you like, or capital gains on those properties. So that's the main thing when we say quarantine. You just can't offset them anymore. And in terms of I think you mentioned sort of investors' cash flow, how does that impact things? I think at the moment, when you're looking at the cash flows of a particular property, you'll normally factor in the tax benefit of having that negative gearing as a cash inflow. So it just means that that's no longer going to be there, particularly if you're buying existing real estate post the implementation of these changes. So from that perspective, it's just something that we need to factor in. And when you're looking at the performance or the quality of an asset, you need to factor that into the cash flows that you're likely going to be spending and receiving in relation to that asset.
Cool.
I do think, just one point, that sometimes it's been sold as don't worry, this property is great because it's going to reduce your tax. And it might be an underperforming asset. There's also probably an element of additional scrutiny now, where people are going to say, great, we still need to understand how good is the property. We can't just rely on the fact that if it underperforms or if it's not great, we can just go, we're giving the benefits. And now people that scrutiny is probably going to come to the fore with not all, but certain properties which have maybe flown under the radar a little bit.
So I've been doing this for a long time, and I can tell you for a fact there are a number of people who would have bought assets or have bought assets purely for tax minimization, thinking that the better the negative gearing, the better the tax outcomes. And a lot of the time, those properties just simply don't have the capital growth and actually haven't performed. So negative gearing works well when the underlying asset is a quality asset and appreciates over time. If it doesn't, well, then you're just stuck with the losses, and there's no upside, there's no gain. It's just a loss. So
that's
great,
true.
There's a tax benefit, but you physically lost money in the process. So, yeah, absolutely. I think I think it's still going to come back to quality assets, whether these changes go through as is or don't or whatever happens next. That focus on quality assets is still going to be as important, potentially even more important, given that you might not be able to negatively gear.
Exactly. New builds and established builds. So the government is obviously heavily favoured on new builds continue to get some traditionally negative gearing benefits. Do you think the tax perks of buying a new build outweigh the, if you want to call it, the historical capital growth of established property, or is there a bit of a tax trap in there?
Look, it's an interesting one. In terms of the changes themselves, I'm not sure whether it's going to have the desired impact that the government's looking for, in that they're sort of trying to incentivize people to buy newer properties, and which will hopefully in turn incentivize builders, developers, whoever, to increase the supply of those properties. I'm not sure by tampering with the demand side of that, they're necessarily going to achieve that in the long run.
Yes.
In terms of, is it better? Again, like we said before, I think sort of looking at that, looking at the quality of the asset is still going to be the main driver. So there are some absolutely ripper new properties. There'll be some absolutely ripper old properties. In fact, we were talking before about, sort of the opportunities in the marketplace at the moment, given the amount of fear that's there. And I'm sure you particularly might have seen some absolute ripper sort of transactions or deals take place. Like if you're buying established property and if you're in the market for established property, there are some absolutely ripper properties to buy. So I think, looking at the quality of the underlying asset is still going to be the name of the game. But yeah, I think the way we go about it might change how we structure. I certainly think that there are some great new builds out there as well. So yeah, absolutely. Like you can look. I wouldn't be choosing one over the other just because of the tax changes. I'd be saying what's the best quality asset in the long term. If I have to forego an immediate tax benefit for future wealth accumulation, then so be it. I personally then would make that trade off. But yeah, look, I think there's definitely some people who will go more towards new real estate, and we are hearing that happening in the market already.
Yeah.
Simply as a means of ensuring that you can continue to negatively gear.
True. Uncertainty doesn't help, and I think that's why everyone's looking at it and saying whether you like the changes or not. I mean, as soon as they clear and they're not sit in that grey area, it just means everyone's able to enable that decision or their decision making a bit more and
Well, I
just
think
move forward.
the behavior normalizes after any, I think, substantial change. If you look at it in history, it takes a little bit of time for that sort of behavior to normalize, investment patterns to normalize. But again, long term, again, those good quality assets will continue to do well.
Agree. So the discount demise, the 50% CGT discount is being scrapped from July next year, mate, and replaced with an indexation method, and plus a minimum 30% minimum tax. So for a middle income investor, does this completely ruin the maths on selling a long term property, or does the inflation adjustment protect them? I suppose there's a few questions in there, but what's your initial thoughts?
So I think if we focus on the indexation versus discount question, if we assume that indexation, inflation runs at, let's say, 3 to 4% per annum, which I think is, thereabouts at the moment anyway. Over 10 years, you're talking about, 30 to 40% inflation adjustment, which is not too far away from your 50% discount in either case. So look, I think in the long term, you're probably going to be okay if you are a long-term investor, long-term buy and hold. I think it'll still be okay. It'll very much depend on the type of asset. So if you're buying an asset which, sometimes you'll buy assets that have great cash flows and little capital growth. Other times you'll buy assets that have high capital growth and the cash flows are not necessarily as great. Some of those assets will potentially have better outcomes as a result of indexation versus CGT discount. But I think, again, overall, in the long term, it's likely that things will probably even out. Where I probably have a bigger issue with those proposed changes is the 30% minimum tax. Now, the reason I have that issue is that I think the government basically have stated that they don't want capital gains or capital profit, if you like, to be concessionally taxed versus income, so salary and wage income. Whereas I think if you're putting a minimum tax on capital gains, you're effectively now taxing that more than you would have been taxing income. You still get access to your tax-free threshold and your bracketed tax and all that.
Staggered.
So I think that's probably a bigger issue I have with it.
Correct. Yeah, it's not fair, is it? If you tax rate, because obviously, it's punishing people for different tax rate positions they're in, right? Isn't it? So
absolutely, and I think a lot of people
level playing field.
100%. And I think the other thing is a common strategy for a lot of people is to wait until they retire before they sell. Minimize that capital gain to an extent, and then sort of reinvest it into something that'll support them better into retirement. It's a very, very common strategy that we see even in our client base. So the fact that you'll now have a minimum tax applied to that, as opposed to being able to avail yourself of not just the current tax brackets, but even future tax brackets that if they presumably would increase or change as sort of inflation continues on. So that's probably where I think there's a bit of an issue with that. But then again, as for accountants, we then have to sort of advise our clients as to how to obviously minimize that tax and go from there. And I think as an example, superannuation might be a good way to do that. But yeah, that's probably more my issue. I was going to go off a massive tangent there for a second, but probably the bigger issue with what I have is that 30% minimum tax.
Existing properties are being proposed to be grandfathered into essentially the budgets. Does this mean if you're an existing property investor that you're, I want to say, safe under the grandfathering, I guess, rules or how that's being put together? Or do you think people essentially will look to lock in and as opposed to maybe sell, if they were going to sell, they'll look to hold that long term? And as you've just mentioned, maybe take advantage of some of those benefits later in life once they're approaching retirement age?
I'd say every asset has a shelf life. Everyone's going to sell. Someone is going to sell that asset at some point in time. It's going to happen. Will it potentially mean that people don't sell sooner rather than they might have otherwise done? Quite potentially. Again, I think over time, behaviors will normalize. I remember my dad used to tell me, so dad's been a CA now for, I don't know, 40 odd years or whatever it is, but he used to say back in the day that when CGT came into play in 1985, it was the same sort of thing, that anything you bought pre that point in time was still excluded from the capital gain tax regime. So if you sold a pre-85 asset, there was no capital gains on it, right? Now, obviously, that's changing as part of the budget as well. But, behaviors normalized after the fact. So I suspect behaviors will probably normalize here at a point in time, or at some point in time. How long that'll take, who knows? But yeah, look, it might have a small impact on some people in terms of holding their property for longer. But no, I think it will normalize in time.
Let's move on. We're going to take a closer look around strategies for people that are looking to invest or have invested as an individual, potentially through a company, or they may have a family trust set up in which they want to sort of control their family's wealth moving forward. So if you're an everyday investor and you're having a look at your portfolio right now and you having it reviewed, what should they or you be thinking about ahead of the 1 July 27 deadline? Is there an opportunity here around which you should be really considering around how do you optimize or restructure your portfolio to make sure you set up, call it for the medium to long term moving forward with your current assets?
I think the problem at the moment with that particular conversation, if you already own assets in a particular structure. So the government, I think, did announce that they would allow a period of time for people to restructure post the implementation of some of these changes. The issue, particularly around the sort of the trust changes and the minimum tax that they're going to apply on that. But I think the unknown and sort of the issue at the moment is that how state revenue officers look at these transactions. Because if you want to restructure and change from a trust to a company or to an individual, whatever it is, that's great. Maybe the government will allow a exemption from a CGT perspective as part of these restructuring efforts, but there's no indication from anyone yet that state revenue officers are going to allow the same. So all of a sudden then stamp duty becomes a real issue, which for a lot of downsizers at the moment is part of the reason why they don't downsize. They don't want to sell and then have to pay stamp duty on buying a new house, which is, I think, adding potentially to the supply issues that we have at the moment.
Correct.
So yeah, I think that's going to be a big issue as part of that restructuring conversation. I wouldn't necessarily go out and start selling assets either, to be honest. I think market conditions are a bit soft if you are a vendor.
Yeah, I'm not advising people to sell unless you have to, right? So yeah.
And I think it's important to note that in terms of these tax changes, you're still, particularly in terms of the grandfathering provisions, you're still getting your discount up until that 30th June 27 valuation. You're still getting that negative gearing is allowed to continue going for assets that you already held prior to budget night. So I wouldn't be in a rush necessarily to change anything. I think the big problem that will occur as part of, if you're looking at your portfolio at the moment, is if you do have trusts involved as part of your portfolio structures. And, how do you potentially get around, or how do you deal with, I wouldn't say get around. I mean, the idea here is not to evade tax. We certainly want to minimize our tax. I think as Kerry Packer famously sort of noted in his sort of speech. But, we probably need to have a careful look at those, how we restructure, how we use trusts going forward. So I wouldn't be in a rush to do anything just as yet. In spite of that, I think, again, good quality assets, continue to hold them. It is definitely a good opportunity to review and say, have we got any non-performing assets that we need to get rid of? But look, we're still, the grandfathering provisions are there. We're still getting this discount up until 30th June 27. The market, as you sort of said, Matt, is relatively soft at the moment. So I wouldn't necessarily be jumping into any substantial changes with existing assets. I think let's wait to see what happens. Let's find out more information in terms, particularly those trust changes, and then let's make some decisions thereafter. I think the more interesting conversation is if you're looking at buying now, what structures how are you going about acquiring? But as I said, I think it's a great time to buy if you're a buyer, and there's certainly no reason why you can't structure appropriately, even with all the changes that are occurring.
Make hay while the sun shines, but while there's a bit of uncertainty, and who knows, we might have another government in a couple of years, and these all might go back to normal. So that's an advisor's dream.
Matty, let's not get into politics on this podcast. We could be here for a long time if we did that.
But no, look, and I think the other part is sometimes, because things are par for the course and might be going well, people don't maybe pay as close attention to their portfolio, whether that be property or otherwise, as maybe as much as they should have. Whereas, it's a good opportunity now with significant reform potentially, as you said, being passed through, revisit that and just make sure that your 5, 10 and 15 year sort of plan is, running along, and
Absolutely.
that's appropriate.
Go talk to your buyers advocates, talk to your property advisors, talk to your accountants, talk to your brokers. I think good opportunity to really review the entire situation.
Take stock.
Yeah, absolutely.
So just as we're looking to wrap up, Kartik, so for a business owner or a property investor who's listening, who feels like their current portfolio setup leaves them a bit exposed, what advice would you give them based on what we talked about today and these proposed changes? Is there anything to safeguard themselves? Like what advice, what take homes would you give the listeners?
Look, I think a lot of these changes, particularly those in relation to trusts, and trusts are very commonly used, particularly as part of property holding, wealth holding, small business structures. A lot of these changes haven't gone through yet, and might very well have some changes to them. Particularly those trust changes, I suspect, might very well have some changes to them before they're actually implemented or legislated. So, assuming that they're passed and legislated, so I would be saying to people, look, don't jump the gun and make any drastic changes just as yet, because we don't know exactly what that sort of the trust legislation specifically will look like, or those changes. But I'd be saying to most people, just go talk to your accountant and start planning for, if these changes do go through, how would that impact, my business? What strategies could I put in place to ensure that I'm not being overly taxed compared to my previous sort of situation? Again, there are lots of strategies theoretically that could be implemented to ensure that we're sort of protecting ourselves from being, overly taxed as a direct result of those changes. So I think having a plan in place for the changes is probably going to be the best way about going this, to ensure that, you're sort of covered. But again, I would sort of encourage most people not to necessarily go out and do anything crazy just as yet, until we probably have more information, particularly in relation to those trust changes at this point in time.
Cool.
Sound advice. Thank you. Thank you for coming along today.
Thank you.
We're going to leave it on that note, and hopefully, when we have another conversation with you in future, we have a few of these items a bit more, essentially, there's some black and white and clarity, and people have that certainty in which they can go and act, regardless of what makes its way through and is passed as law.
Absolutely, and I think that's what most people at this stage are looking for, is just a bit of stability so that they can plan for their future and carry on.
If you would like to keep receiving property insights and golden nuggets from our guests, please do follow us, and you'll get the latest episode released on a fortnightly basis.